Ever wonder why gold always seems to be in the spotlight when it comes to investing? You know, that shiny yellow metal that people call the safe haven during times of uncertainty? But here's the thing. Gold's price doesn't just magically appear on a chart. It's driven by a bunch of factors that most of us don't usually think about. And let's be real, understanding the price of gold isn't like trying to decode the Da Vinci Code, but it's also not a walk in the park either. Still, don't worry. By the end of this video, you'll know exactly what influences the price of gold, and you might even feel smarter than the next guy who's just hoarding gold bars in his basement for fun. So how does the price of gold really move? Is it all about supply and demand, or is there something more to it? Let's dive into the 7 key factors that impact gold prices, and trust me, it's not just about big, scary economic terms. This is real-life stuff that you'll notice in the headlines and see affect your investments. And yeah, I'll throw in a couple of fun examples too to make this all stick. The first thing is the global economy and gold's reaction. The global economy is like that weather report we all check before stepping outside. If things are looking stormy, you grab your umbrella, or in this case, you grab some gold. When the economy takes a dip, gold becomes the shiny object people go to for protection. For instance, during the 2008 financial crisis, gold prices didn't just rise, they skyrocketed. It was like gold became the VIP of investments. It was like, oh, you're worried about your stocks? Don't worry, gold's got you. Fast forward to today, and the global economy is still facing some turbulence. With the aftermath of the pandemic and some lingering global debt crises, people are once again turning to gold. Why? Because gold tends to be that reliable friend who shows up when everything else is falling apart. Just look at gold's price, hovering around $3,044 per ounce in March 2025. Why? Because people aren't feeling so great about the economic outlook, and gold shines when things look murky. It's like gold's that friend who thrives at the party when everyone else is looking for the exit. The second thing is inflation and interest rates. Alright, let's talk about inflation and interest rates now. These two are like Batman and Robin, except, they might not always be on the same team. Here's the deal. When inflation is high, the value of your dollar starts to slip. You're paying more for the same things you've been buying for years. And what do people do when their money starts losing value? They look for something that holds value. That's right, gold. Gold tends to increase in value when inflation is on the rise, making it an attractive option. Now here's where the interest rate part gets a little tricky. You'd think higher interest rates might make gold go down because people can earn more from bonds or savings accounts, right? But hold up, it's not that simple. The Federal Reserve's rate hikes in 2023 kept interest rates high, and yeah, it slowed gold's price a bit, but it didn't send it into a downward spiral. Why? Because inflation is still a bigger concern. And while those high rates might make bonds look nice, inflation is like the monster that just won't go away, pushing more people toward gold. The third thing is the strength of the US dollar. Here's a fun one. The dollar and gold are like dance partners. When the dollar gets stronger, gold tends to get a little weaker because gold becomes more expensive for people using other currencies. But when the dollar's value drops, like it has in recent years, the price of gold goes up. It's like this awkward but totally real dance where one's moves affect the other. And right now, the dollar's taking a bit of a dip, which is one reason why gold prices are seeing some upward movement. The fourth thing is central bank purchases of gold. Now, onto something that might sound a bit boring, but trust me, it's important. Central banks are the big players in the gold market, and when they start buying gold, prices tend to rise. Why? Because they know what they're doing. In 2024, for example, China added 200 tons of gold to its reserves. And when China buys that much gold, it sends a clear signal. Gold is still a good bet. And guess what? Other countries start paying attention. It's like when you see your friend investing in something that's going up, and you think, hey, maybe I should jump in too. In 2023, central banks purchased a record 1,136 tons of gold, which shows that nations are increasingly diversifying away from US dollar assets. This significant increase in gold purchases by central banks isn't happening in a vacuum. Many believe it's a direct response to concerns about the long-term consequences of money printing by these same institutions. As the value of paper money potentially becomes less certain, central banks are increasingly turning to gold as a reliable store of value. When central banks make moves like this, the price of gold gets a nice little boost. The fifth thing is phantom debt and how it affects the economy. Now, here's something you probably haven't thought about: phantom debt. What does that mean? Well, phantom debt is a term coined by Tim Quinlan, a senior economist at Wells Fargo, and it refers to the unreported debt accumulated through buy now, pay later platforms. These services are growing rapidly, and the numbers are staggering. In 2024, Juniper Research predicted BNPL transactions would hit $334 billion, and that's expected to double to $687 billion by 2028, representing a growth of 105%. But here's the catch. This debt isn't fully reported in the financial system, meaning it's effectively invisible. This missing data creates a $700 billion hole in economic reporting because, in the US, there is currently no reporting mechanism for these buy now, pay later platforms to report this information. Now, why is this unreported debt so significant? Well, it challenges the commonly held belief that the US economy is strong thanks to robust consumer spending. The fact that a large portion of this spending is fueled by unreported debt suggests that the conventional metrics we use to assess consumer financial well-being might not be painting a complete or accurate picture. This raises concerns about the true health of the economy. This missing data creates a $700 billion hole in economic reporting. Why does that matter? Well, if you're basing your economic outlook on conventional data and missing this kind of information, you're not getting the full picture. The result? Investors and policymakers may overlook growing consumer debt levels, leading to decisions based on incomplete information. Adding to the concerns about hidden debt, traditional metrics also reveal a worrying trend. Consumer credit card debt is at a record high, while personal savings rates are at a record low. This combination suggests that many Americans are relying heavily on credit and have little savings to fall back on, making them more vulnerable to economic shocks. This underlying financial stress further supports the argument for gold as a safe haven. The sixth thing is the risk to regional banks due to real estate loans. Another factor putting pressure on the economy and gold's price is the situation with regional banks in the US. These banks are heavily involved in real estate loans, and as interest rates rise, so does the risk they face. Currently, $1.9 trillion of real estate loans are outstanding, and regional banks hold a significant portion of that. With inflation still high, rising interest rates, and growing consumer debt, these banks are facing major pressure. It's like a time bomb waiting to explode. As Barry Stern, CEO of Starwood Capital, has pointed out, the real estate market is like a fragile animal, and when it starts to show cracks, they're going to get bigger fast. A potential housing crash could put regional banks in serious jeopardy, which would likely ripple through the economy. As these cracks become more apparent, more people will turn to gold as a safe haven, pushing its price higher. The seventh thing is criticism of money printing and its impact. Now let's dive into a very important issue that could really affect gold: the printing of money. Former Bank of England Governor Sir Mervyn King has been a vocal critic of the central bank's approach to money printing. He believes that by printing more money to solve economic problems, central banks are ignoring the long-term consequences. As King pointed out, the idea of quantitative easing, the process of injecting more money into the economy, has led to some of the problems we see today, including inflation and instability. This critique is important because it shows the dangers of relying on money printing as a solution. It's something that could eventually destabilize currencies and further increase the demand for gold. As gold holds its value better than paper money, it's no wonder people are flocking to it as central banks continue this strategy. Sure, when we talk about gold, we usually think of it as a financial asset, but here's the thing: gold is also a huge part of the jewelry market. And that market, it drives gold prices up, especially in countries like China and India. In fact, Asia accounts for over half of global gold demand. So, when Chinese consumers are out buying gold like it's going out of style, it's not just some local trend, it's a global gold rush. Even though gold's price has hit new highs recently, people in places like China are still buying gold. They're not just buying it for the bling factor either, they're buying it as a store of value. In fact, gold is often seen as a safer investment there than in some of the more traditional forms of investing. It's like buying real estate, but without all the paperwork and maintenance. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide. Now, if you're tired of these so-called stock market experts blabbing about the same picks over and over again, I've got good news. I found an investing newsletter that completely blows the competition out of the water. They find highly asymmetric stocks with low risk and high reward, the kind you'll never hear about on CNBC or other major stock market news sites. I'm talking about companies like Ukrainian agri-producers during a war, or Bank Handlowy in Poland, a solid bank trading at insanely low valuations. These companies aren't flashy. Many of them produce boring products or provide services in oil and gas, banking and agriculture. But here's the thing, they make money. And by investing in stocks like these, you can too. For a limited time, they're offering a 30-day trial for just $1. But as a thank you for watching this video to the end, I can do even better. Click the link in the description and tell me your best email address so I can send you their recent newsletter for free. It comes with 5 stock recommendations as well as high-quality market analysis, so make sure you check it out. You've literally got nothing to lose.